Hello, I'm Tom Gosling, Executive Fellow at the European Corporate Governance Institute, and I'm here with Jim Whittington, Head of Responsible Investing from Dimensional Fund Advisors, to discuss our series, Does Sustainable Investing Work? So Jim, thanks so much for joining us today, and perhaps you could tell us a bit about your role at Dimensional and indeed the firm itself.
Yeah, so Dimensional are a global asset manager. So we have over 700 billion US dollars in AUM at the moment, and it's predominantly in long only equity and fixed income strategies. And we have a 40-year history as a systematic manager. So that means we take research around empirical finance, combine that with our expertise in implementation. We think that's really our secret sauce. And we provide well-diversified strategies to our clients. We are very research and evidence-based. So we have very close connections with a number of Nobel Prize winners, for example, such as Gene Farmer, Bob Merton. And I'm Dimensional's Head of Responsible Investment. So I have oversight of everything ESG, which is going on at Dimensional. And I think my focus is to try and bring that same rigor and evidence-based approach that we bring to investing to our approach to ESG and ESG investing.
So I'd like to start with your reactions to the series of articles we put together, and we'll put a link to the original articles and also my interview with Harald Walkate in the show notes, which gives a bit more on this. But in brief, we use the analogy of a three-stage rocket required to put a satellite into orbit. So in stage one, the investor's actions must have some effects on the companies in which they invest. So for example, divesting from a dirty company might increase its cost of capital. In stage two, managers at the company must then actually respond to that effect and so change what the company does in the real economy. So for example, they might respond to the increased cost of capital by investing less, and so fewer dirty goods are produced. And in stage three, this impact has to persist and must not be unwound, or at least not entirely unwound, by the response of competitors. So they don't increase production of the dirty good to offset the reduction at the first company. And so that's a very brief summary of our model. And our review of the academic evidence suggested that conventional sustainable investing techniques struggle to make it through all three phases, which led us to conclude that sustainable investors wanting to have impact perhaps need to have more modest goals and focus less on achieving outcomes directly and more on influencing the circumstances in which good outcomes can occur. So in terms of your reactions to our work, and thanks very much for taking the time to read it, let's start with, what did we get right in your view?
I think it's really helpful to have this type of analysis and this type of project. There's a lot of focus in the industry at the moment on sustainability outcomes. I was at a conference a couple of weeks ago where the title was Driving Real Change, and you can see the regulatory agenda as well is moving towards really asking sustainable investors to think about real world sustainable outcomes. It's a big focus, for example, of the UK regulators at the moment with their SDR labelling regulation. And I think your three-part rocket is an excellent model for laying out what is required for sustainable investors to have that type of direct causal impact on real world outcomes. What I particularly like is your distinction between stage one and stage two. So company impact is different from investor impact. Given that most of us are investing in secondary markets, that's a really important point. What matters to you as an investor is how far you can influence companies to adapt or change their behavior in a more sustainable direction. Other people, I think, have said that in other ways before, but I particularly like your stage three, which then brings in this idea of equilibrium thinking, which is so important to economists. And I ask the question, well, if you get that company to change its behavior, how do you know that's not going to be cancelled out by other people changing their business practices? So if we divest from fossil fuels in a particular company we're invested in, it's not going to help climate or help the planet if those fossil fuel assets are just bought by a private company and continue to be used and emit greenhouse gas into the atmosphere.
So far so good. But what about what we've got wrong?
Yeah, so there are a few things I think in terms of your recommendations that I would personally take issue with. Mm-hmm. So firstly, you're pushing or suggesting that asset managers should take more of a role or get more involved in public policy advocacy. And I don't personally believe that it's the role of asset managers to take a significant role in public policy advocacy beyond things which are narrowly or directly relevant for investors and the financial returns to our investors. And there are a number of reasons for my position. I think, number one thing is normally when we're thinking about public policy advocacy, you're thinking about asset managers advocating for things that we want to happen that align with my beliefs. So I care deeply about climate change, so I'd love to see asset managers lobbying for climate. But how would you feel if asset managers started to lobby about things you didn't believe in? So, for example, lobbying for a relaxation of gun controls, for example, or in the UK, lobbying for privatization of the NHS, which is, something we hold dear to our hearts. So I think it's important to think about all sides of this particular debate. And the second issue I have with it is this question of legitimacy. We are servants to our clients. They entrust us to manage their money on their behalf. That doesn't give us, I don't think, a great license to try and tell politicians or society how it should be run. I don't think people really want the titans of finance or, Davos man, as he's sometimes called, running around and telling people how we should organize society. There are other channels with more legitimacy to do that. So, I think we should maintain focus as asset managers on things which directly relate to our investments and our clients' returns. And the second comment I had about things which I would take issue with, and I'm not sure whether you yourselves would take this position, but I think many people are over optimistic at the moment in terms of the potential benefits of stewardship or the impact that we could have through stewardship activities. And I think there's a misunderstanding really of the levers that we have available. So you sometimes hear people say that shareholders are owners in the company, and that's kind of lazy language. You're not an owner in the sense you can't tell the company what they should do. If you turned up at the Christmas party, you're going to be turned away by security, and that's because as shareholders, what you actually own is share certificates that have particular rights attached to them. For example, the right to elect directors, and they're actually quite narrowly defined rights. And I think those rights are less strong than many people imagine. To give you one example, director votes. We get to vote on directors, but often these director votes are uncontested. You don't have an option. You have just the people that are being proposed by the board. And even if you vote against or abstain on those candidates, many companies, they have the option of continuing to engage that director. These are called zombie directors out in the US, and there's 50 plus companies with those types of directors that don't have majority shareholder support. There's a lot of focus in our industry on shareholder proposals. There was something like 300 environmental and social shareholder proposals last year, but shareholder proposals, again, they're non-binding, and you're not allowed to micromanage the company's affairs. And even when they're passed or they get majority support from shareholders, which is very rare, there was a recent study by the PRI that found that only a quarter of them were actually implemented by companies. Companies are well within their rights to ignore shareholder proposals. And the last thing I would highlight is, the fact that a lot of companies have dominant shareholders. So according to one data set, approximately almost half of global market companies, at least by the number of names, have a dominant shareholder defined as a shareholder which has up to 30%, which has 30+% of ownership and has control. So those types of companies, and they're particularly prevalent in emerging markets, where we know you kind of see the worst emissions and the emissions profile, and where we struggle on some of these issues. So a lot of those companies don't need to pay attention to diversified shareholders such as ourselves, because they are protected by this dominant shareholder. And the last point I'll make about this is, people often argue that we can advocate for systemic change through stewardship. But if you're really annoyed with a company's response, if you don't like the transition path the company's on, and you've engaged with them and you voted against directors, what's the last rung of the escalation ladder for a manager such as us? Well, it's going to be divestment. But this gets back to the problem. If your divesting doesn't particularly have a strong impact on companies, and that's the strongest lever that you have as your threat from engagement, then how can it be that engagement is going to have a substantial impact on these issues as well? So we think engagement is important. We have a stewardship team that conducts engagement. We do think that you can influence or nudge companies, but we're not going to achieve systemic change on environmental and social topics, I don't believe, through stewardship alone.
I mean, that's really interesting feedback, and I think it in some ways, I think what you're saying aligns with our view around the limitation of some of these tools, but it's also a note of caution that sometimes in our desire to figure out how we can have an impact, notwithstanding the evidence that we don't have great efficacy, we still reach for things that we try to do. So I think that's a really good note of caution. And so the third question I have for you on this then is, are there some things that in your view we just missed, just didn't incorporate at all in the analysis?
Yeah, so in terms of the model itself around the three-stage rocket, it seems like the worst that you can imagine happen is this rocket, fires off, doesn't make it into orbit. Perhaps it's an attractive firework that people can enjoy. But, I think that downplays the risk, and the very serious risk. There might be unintended consequences from launching all these rockets. So first of all, it might be very expensive launching rockets that don't make it into orbit. They might take out other rockets that are carrying satellites that would make it into orbit. Or perhaps we should envisage it, you're launching this rocket in a crowded conurbation, and there's a risk it might fall to Earth and have some serious unintended consequences.
You've extended this analogy beyond what we could have imagined it doing, Jim. It's fantastic.
I find rocket launching very worrying as an activity. So yeah, and if you think about some of the unintended consequences that we see, and I think you see these all the time, even in the field of stewardship, I know this is something that you've looked at, ESG metrics in compensation. And it sounds like a great idea that you incentivize management with ESG metrics. But what we see time and time again is those metrics aren't well defined. They're not stretching. They typically pay out 100% of the time. So what happens is you're replacing stretching metrics that make management accountable for performance for basically padding their pay. So we need to be alive for these types of risks. One that particularly worries me is the systemic implications, I think, of ESG and disclosure requirements. So there is a tension, in my view, between things like asking companies to disclose all these sorts of environmental and social variables, the cost, the management attention that takes, and the fact that could well detract their attention from innovating and growing. So there's a real risk there that we might end up slowing growth through all these disclosure mandates without any clear real benefit. And I know this is something that the European Union and people in Brussels are very worried about, is the relatively low rate of growth in the European Union relative to the US. And I do wonder how much of this is related to this big push for regulation and disclosure mandates and things like that.
Yeah, interesting. What do you think as well about the applicability of the model to secondary market investors? Is that, you know, are we right even to focus on this channel as agents of change?
Yeah, I think it's a very useful model for people claiming to have a direct causal impact on sustainability outcomes, but it's not the only model.
Mm.
So something that I like to talk about, and another model I'd say, is from the field of sports science.
Mm-hmm.
So in sports science, it's well established across lots of different sports, lots of different countries, that the home team has an advantage.
Mm.
And one of the contributing factors to that is believed to be the home crowd, you know, geeing up the home team, perhaps putting pressure on the referees
Mm-hmm.
to be implicitly biased. But either way, you see it in the data, home crowd most likely has an impact. But if I go, you know, to the Emirates Stadium at the weekend, watch my team, and we win, I'm not going to come out and say I've had an impact. You know, that's not going to be the type of impact that's well explained by your satellite model.
Yeah.
And for diversified secondary market investors, you know, I think that type of model is probably going to be more realistic. You know, we all hold very small slices of individual companies. What we do and the impact we have will depend on what other investors choose to do and the types of activities they're doing. So, you know, when it comes to this issue of very complex issue of how social norms get set, you know, the social license to operate, establishing the zeitgeist, I think that there are mechanisms and other channels that aren't necessarily well explained through this direct physical causal model that you've established.
Yeah, that's a very good challenge, and actually one of the dangers of the direct causal model is in some ways it's underpinning the direction that some regulation and stewardship has gone recently in trying to demonstrate that direct causality, whereas what you're suggesting is that actually any influence that investors have may be much more difficult to pin down and therefore doesn't necessarily lend itself to that sort of regulation. So that's really helpful feedback. I'd like to turn now to how you think about sustainable investing or responsible investing at Dimensional. So what have you concluded about the proper objective of responsible investing? Is it about enhancing returns, delivering impact, or more about reflecting client values? And what is it that your clients are really looking for?
Yeah, so as I said at the beginning, we're an evidence-based investor, and we have looked at the research around ESG and returns and ESG and risk, and we don't see compelling evidence that ESG is a driver of enhanced returns or reduces your exposure to risks. So, you know, we don't see evidence of an ESG premium. So we're not integrating ESG into portfolios in order to target higher expected returns. There are other ways we seek to do that. Now, in terms of having an impact, you know, I'm really happy to see academics looking at this question, and we've read some of the papers that you reference in your project. So we're not convinced, as I think you and Harald aren't convinced either, that it's easy to demonstrate this direct impact on sustainability outcomes in the real world. You know, we don't want to claim something that we can't evidence in some robust way. So, of course, we would like to help our investors and our clients have more of an impact on these types of issues. And we continue to look at this sort of work. But really, the one thing we know we can help deliver for our clients is to help align with their values. Now, you know, I know you mention it in your paper, but in my view, you kind of gloss over it and underplay how important it is in terms of helping clients align with values. And I sometimes worry that ESG in finance is really us discovering and feeling our way towards conclusions that are well established in other fields. You know, so things like development studies or sociology or even philosophy. I think philosophy is a really important one. And in philosophy, there are two big schools, or the two main schools of ethics are consequentialism and deontology. So consequentialism says that the moral value of an action depends on its consequences, outcomes in the world, whereas deontology argues that the moral value of an action is intrinsic. You know, there are some principles about what's right and what's wrong. And you see that in the ESG industry, we've run down this consequentialist path. You know, it only matters if you're having an impact. But of course, that isn't the only answer. I don't think that's the only perspective that's out there, or the only perspective that is that you can support. And we wouldn't have a deontology score if there weren't some good arguments to support it. To give you an example, I've recently been reading a book, very good book, about the abolition of slavery movement in the United Kingdom. So I think it's something like 1830, the slavery was finally abolished in the United Kingdom. And it was after a very long path that took decades. But if you're an investor in, say, 1800, before the abolition of slavery, what would be the right thing for you to do? So at that time, there was no economic argument for slavery to be abolished. There's lots of industries in the United Kingdom that were heavily dependent on slave-produced products. There wasn't a very strong public consensus for the abolition of slavery either. You know, I don't believe there was a consensus. So as a private individual, you know, what would have been the right thing to do at that time? And for me, I think you'd say, right, probably the people that are on the right side of history there are the people that boycotted slave-grown products. I think divesting from slave traders or slave dependent businesses in your portfolio would have been the right thing to do. And maybe you join the abolition movement and you campaign politically. But, you know, in that type of context, I don't think it's feasible to say, right, well, you shouldn't do anything because it's not going to have an impact. And it was interesting to me that that was actually one of the arguments that was made against the abolition of slavery at the time. Right. So back in the day, big rivalry between the British and the French. One of the arguments that was made was, we can't abolish slavery because it will just benefit the French. So the French will expand their operations. They'll get to benefit from our abolition. But, you know, William Wilberforce, one of the leading lights of the abolitionist movement, spoke very forcefully against why that's wrong-headed. Because you can basically, and the point William Wilberforce made is, you can basically argue for anything. You can murder, you can kill, you can commit any kind of crime on the basis that if you don't do it, someone else will do it in your place. And obviously, I think most of us would agree that's wrong. So I think there is a very important place for values-aligned investing. And the more people that are aligned or aligning with their values, I think the more effect, more power it has as a social movement.
I think that's an incredibly thought-provoking answer. So how do you decide which sustainability issues to focus on when you're looking at this question of values alignment for your clients?
Yeah, as I said, we think that asset managers need to be good at listening to their clients. It's not our job to tell people, you know, what's right and wrong. And we've got lots of different channels to understand our client values. And we seek to engage with our clients through lots of different channels. So we have one-to-one meetings, of course. We've established sustainability councils, which are groups of financial advisors, consultants that are a sounding board and help inform us about how clients, what they're hearing from their clients about what matters in this space. And then we run structured surveys of different groups of clients, so institutions, financial advisors, even end clients. So this is why we're trying to be thoughtful and surround the problem with these different mechanisms, you know, so not put too much trust in any one mechanism. And our clients have told us, really, the number one issue that is of importance to them is climate change in their portfolios. And, you know, I would say that's predominantly because it is such an important ethical challenge, an ethical issue for so many people. Because, you know, the problem with climate change, of course, is it's the global rich, not only the global rich countries, but predominantly the richest in those countries that are contributing most to climate change. And if the forecasts are to be believed, the most damaging effects of climate change are going to fall on the poor, both the poorest countries in places like sub-Saharan Africa, but also within individual countries as well. So that doesn't sit well with lots of people. That we're redistributing effectively away from the poorest to give to the rich. So there is a very challenging ethical dimension to climate change that people, I think, care about deeply. So that's really why we've ended up with this focus on climate change. There are other environmental and social topics that we consider, but the number one is climate.
And in practice, how do you go about implementing that focus on climate in your sustainability strategies?
Well, number one is the availability and quality of data. So we need to build our approach on robust data. Number two, we absolutely want to provide as robust an investment solution for clients. We don't want people to have to compromise on investment outcomes to align with their values. So we work very hard to be very diversified, to target the same premiums that we target in our conventional non-sustainability portfolios. So what we do in practice in terms of the sustainability implementation is we're looking at things like greenhouse gas emissions data. Now, emissions data, in particular Scope 1 and Scope 2, most widely self-reported data set. And also we know it's particularly salient in terms of what's driving climate change. So what we'll do is at the portfolio level, we'll exclude those companies at the highest emitters, with the highest emissions intensity. We'll also exclude companies with the highest potential future emissions in the form of fossil fuel reserves. But then within each sector, we're also tilting away from companies that have the highest relative emissions in their sector and towards companies with the best sustainability profile relative to their sector peers. So, Alex Edmonds, one of your colleagues, he wrote a paper, I think last year, talking about the value, theoretically at least, of tilting as signaling what type of behaviors we want companies to employ. I think there's a little bit of that in our tilting approach within individual sectors. And then lastly, we do have a range of environmental and social exclusions that we try and focus on particular issues that are important to clients. The key word there is focus, because we don't want to end up being overly concentrated or end up reducing the opportunity set too much through the exclusions.
And in that context, I mean, there is a concern that tilting portfolios or excluding certain types of company can lead to distortions in portfolio construction that can ultimately harm client risk-adjusted returns. How do you go about managing those financial risks?
Yeah, it's a trade-off. And this is something we try and be clear with clients that there are trade-offs involved with investing sustainability with the sustainability funds. You can't have it both ways, unfortunately. You can't say I want to exclude, I don't know, tobacco from your portfolio and then be concerned about the high returns that are available from tobacco stocks. So to date, because of the broad diversification of our portfolios, because of the construction is very deliberately designed to be parallel to our conventional funds. To date, they perform largely in line across a wide variety of asset classes, both equity, different classes of equity, fixed income. So we think that's a proof statement in terms of we're doing what we set out to do. But we can't guarantee that that's always going to be the case in future. So if the climate transition is slower than we expect, if companies with lots of fossil fuel assets outperform, that's going to detract from our sustainability portfolios relative to our conventional funds. But then, of course, on the other side, if the transition's faster than the market currently expects, then that could well benefit sustainability investors. So, this type of active decision is an intrinsic part of sustainability investing. We want people to be aware of that. We try and manage it through diversification, but there's only so much you can do. And I would say, there are some things you can do. There are other things that people can do. You can advocate. You've got choices in terms of how you cast your votes in elections. Are you supporting strong government policy on the transition? You know, and I invest in our sustainability funds, and I think one important consideration there is, does that align, or does that incentivize me to take other steps which I think are important in my life, you know, such as voting for particular parties. You know, it seemed to be a weird thing if you're voting for a 2050 transition at the same time as loading up your portfolio with fossil fuels or things that would be hurt by that sort of transition. So
yeah, it would be a weird sort of diversification strategy, wouldn't it? So yeah. So Jim, thanks so much. That was a really insightful, terrific discussion. Thank you for taking the time.
thank you, Tom.